Dan Fitzpatrick here, stockmarketmentor.com, and hope you all are doing well. Hope all of our friends back east are safe and taking care of business. So sorry about what's happening, but I want to talk about CrowdStrike here. You guys know what happened. They really blew it. Stock took a big hit, almost 50% hit from where it was. And since the sell-off was done, and by the sell-off, didn't really work out for quite a few days, actually like a couple weeks until finally it did. So now this thing's climbing back up. It's finally just today cut through the 200-day moving average. And if you're just looking at this price picture, you can see this kind of trade. Now, typically, this kind of, well, not typically, I'd say this time too. This kind of a triangle is a bearish, it's like a bearish pennant. And the idea is you've got higher highs and higher lows, but they're converging. So the lows are coming up closer and closer to the highs. Volume, not that great back here. Got a nice move higher here, probably because it's popping above the 200. But you want to be careful about this kind of move, because most of the time, not all the time, but most of the time, when you see these bearish wedges like this, they tend to fail. They tend to ultimately fall out the front of the megaphone here. This kind of looks like a megaphone. This is the big hole where the sound goes out. This is the little hole where the voice goes in. So they tend to just kind of fall out here like this. So I'm just suggesting you be careful with this. I have some stock, and I also have some call options, the 300 calls, November strike. And I'm profitable on those. 6%, not a big deal at all. And frankly, I'm probably not going to keep them very long, because for one thing, I'm going on vacation next week, but also I feel like this stock is right back to the bottom of this gap. You can see where this stock gapped down, and I'm just kind of looking at closing prices here, not really anything else. But so it's trying to get into this gap. And so far, it's not quite doing it. So I look at this gap, and it just seems to me like we could have more selling pressure. That's not always the case. Sometimes this thing will climb right through. And so you can say this more cynical of you, and I see these stupid comments from trolls like, okay, so what do we do? Dude, it's a free video, okay? You get what you pay for. Sorry. But with that said, you got to manage your risk. And so if you're buying this breakout, for me, the way to do it is I like it here. If the stock falls back below its low here, like its open price, if it falls back below there, well, then this breakout is suspect, because it tried to get up above the 200 here, couldn't do it. And so then you see the pattern that I just drew. And so this would kind of be a logical thing for this if it fails to fall all the way down here. So a real tight stop would be at about a little over 3% from the 200-day moving average. If you want to be a little more aggressive, you can have the stop clear down here where mine is at 280. And so what I've done is given you two risk profiles, one that's really, really tight based on a swing trade breakout above the 200, and one that's looser just based on dropping below the last week or so of price action. So that's all I got for you. By the way, anytime now, and for all I know, it may have started already, we're going to be marketing the 59-minute trader workshop that I teach, that I used to teach. It's going to be on the 2nd of November is when that is. So you may want to mark your calendars for that. This is the most popular course that I've ever taught. And I'm going to be doing it again. It's completely updated with new indicators and a bunch of new things, frankly, that I didn't cover in the last one. So even though the name is the same, the material is completely different. So they're probably going to start marketing this pretty soon. And so if you're watching this video, you're probably on my email list and you'll be seeing those. So anyway, I hope you come. If you don't, you don't. If you do, my feeling is you're going to wind up making a crap ton of money.